They didn't delete a footnote. They deleted the last legal lever that could pull paper silver back to Earth. Rule 11.11b. April 1, 2026. Gone. It wasn't optional language. It wasn't fine print. It was the only clause in the entire COMEX rulebook that mandated physical delivery, forcing sellers of silver futures to hand over real metal, on demand, within strict deadlines. No exceptions. No waivers. No, subject to availability. Just, the seller shall deliver physical silver. That clause was silver's price anchor. Gold lost its delivery mandate years ago, but gold had inventory. Silver didn't. By March 2026, COMEX vaults held under 180 million troy ounces. 5 months earlier, 530 million. That's a 66% collapse. 350 million ounces vanished in 150 days. Not sold, not shipped, gone. Kitco insider confirmed why. London vaults faced a parallel 150 million ounce shortfall, meaning both global settlement hubs were already operating on borrowed metal before the rule disappeared. This wasn't preparation, it was exhaustion. And then came the deficit. 212 million ounces. The largest in modern history. That's not a number on a spreadsheet. That's 14% of total annual silver supply drawn entirely from above-ground inventories. Not new mine output. Not recycled scrap. Just vaults empty. So ask yourself, what happens when the only enforcement mechanism vanishes, right as the vaults go silent? This wasn't risk mitigation. It was surrender. Because without Rule 11.11b, there is no legal path to force paper into metal. No way to test whether the contracts represent real supply or just arithmetic. No backup anchor. No fallback mechanism. Just metal and how much is left. They didn't delete a clause. They deleted the last thing standing between paper promises and physical emptiness. That ratio didn't widen. It tore. 89.4. 90 ounces of silver just to buy 1 ounce of gold. The widest spread since 2024. The most common headline? Silver is cheap. But that assumes something still works. It doesn't. Arbitrage, the invisible shock absorber of precious metals, requires 3 things. Buy silver. Sell gold. Then deliver physical metal to lock in the spread. That third step? It's gone. Not paused. Not delayed. Blocked. COMEX no longer mandates delivery. London vaults report a 150 million ounce shortfall, enough silver to fill 3,000 Olympic pools, missing from the very places where metal should sit, ready to move. So when Bloomberg reported silver breaking $90 an ounce in January, gold wasn't moving with it. Gold was flat, stalled at $5,200. That doesn't happen in a connected system. That happens in a fractured one. Industrial buyers aren't waiting for gold to rally. They're ordering silver paste for solar panels today because supply chains don't hedge ratios. They hedge deadlines. Retail investors aren't buying silver as a gold proxy. They're clicking buy physical bar, not ETF shares, because after January's 36% intraday crash, paper feels like theater. And central banks? They're quietly allocating silver into sovereign vaults, not as reserves, but as monetary insurance, precisely because it's not gold. It's tighter, scarcer, more industrial, more real. 3 demand streams. 1 shrinking pile of metal. 0 delivery pathway to balance them. That's not cheap silver. That's unmoored silver. The ratio isn't measuring value. It's measuring rupture. A thermometer reads temperature. A scar reads trauma. 89.4 isn't a signal. It's the first visible crack in the last structural link between silver and gold's monetary gravity. Gold still trades on faith, on central bank demand, on dollar weakness, on geopolitical risk. Silver used to trade on metal, on vault receipts, on delivery tickets, on the quiet, ironclad certainty that if you held the contract long enough you got the ounce. April 1st erased that certainty. And the ratio didn't just widen. It went silent. Where machinery used to hum, there's only air. No anchor. No stabilizer. No shared gravity. Just price rising, not because it's due, but because the floor just vanished. They arrived. Same week. Different reasons. Same vault. Industrial buyers didn't wait for gold to move. They didn't check the ratio. They didn't hedge. They ordered, and their contracts demanded physical silver, delivered by March 15. A German solar manufacturer, $247 million order. AUSAI Chip Foundry, 8.3 million ounces non-cancelable, non-deferrable. An EV battery consortium in South Korea, 12-month forward contract payable in euros, deliverable in Seoul. All of them requiring real metal. All of them consuming it permanently. Not storing it, not trading it, just gone. That's what 9% industrial demand growth means, not a headline, but a withdrawal slip. In 2024, that surge consumed 127 million ounces, enough to fill 2,500 Olympic pools. And none of it comes back. It's wired into solar panels, etched into chip substrates, pressed into battery cathodes, permanent removal, zero recycling in the short term, zero buffer. Then came the investors, not ETF buyers, not paper traders, people who clicked, buy 100 Oz bar, and got an email saying, out of stock. Next allocation, April 12. Priority given to clients holding physical custody accounts. That shift didn't happen gradually. It happened after January 30, 2026, when silver plunged 36% in one day. Bloomberg called it a record intraday decline. What it really was, the final collapse of trust in paper silver. Because when the crash hit, ETFs dropped 41%. Physical premiums spiked 220%. Dealers stopped quoting prices and started quoting wait times. One major US distributor updated its homepage with 3 words: bars, allocation only. No price, no availability, just a queue. And then quietly the sovereigns moved. Not with press releases, not with fanfare, but with vault-to-vault transfers. With unlisted deliveries, with physical silver routed through Zurich, Singapore, and Dubai outside COMEX and LBMA reporting channels. Why? Because the Silver Institute confirmed it. This is the 6th consecutive year of structural deficit. And deficits don't scare central banks. Scarcity does. They weren't buying silver as a reserve asset. They were buying it as monetary insurance, diversifying beyond gold into a metal with deeper industrial utility and tighter physical constraints. 3 streams, 1 destination, 0 coordination. Industrial demand doesn't negotiate price, it meets deadlines. Investor demand doesn't wait for signals, it reacts to scarcity. Sovereign demand doesn't trade, it secures. And with COMEX's delivery mechanism gone, there is no marketplace to balance them. No auction, no clearinghouse, no shared reference point, just metal. And how much is left? So ask yourself, what do you do when your solar panel supplier says, we'll ship in Q3 if silver clears customs? What do you do when your broker says, we have bars but only for clients who already hold physical custody? What do you do when your central bank quietly shifts 5% of its reserve allocation not into bonds, not into gold, but into locked vaults of silver? You stop asking about price. You start asking, who gets served first? The answer isn't in the chart. It's in the vault log. It's in the refinery schedule. It's in the shipping manifest. And right now the winner isn't the highest bidder. It's the one who shows up first. With cash, with custody, with a contract that says, deliver metal. Not promises, not paper, not arithmetic. Metal. This isn't demand growth. It's demand convergence on an empty shelf. It's not $100. It's the moment the vault clerk stops quoting price and starts checking your custody account. April 12, 2026. A major US precious metals distributor updates its homepage. 3 words. Bars. Allocation only. No price. No availability. Just a date and a condition. That's not marketing. That's triage. Because at $100 an ounce, industrial buyers aren't negotiating. They're hoarding. A German solar manufacturer just pulled forward all of its Q3 silver orders because its supplier said, no allocation until May unless you pay 15% premium and take delivery in Zurich. Retail investors aren't clicking, buy ETF. They're calling vaults asking if their account qualifies for priority allocation. One client got this reply, you're Tier 2. Wait time, 11 business days. Tier 1 clients, those holding physical custody, ship same day. And central banks? They're not placing orders. They're rerouting shipments through Dubai, through Singapore, bypassing COMEX and LBMA reporting entirely. Why? Because the Silver Institute just confirmed it. This is the 6th consecutive year of structural deficit, and deficits fade. Scarcity doesn't. Let's be clear about what $100 really means. It's not a technical level. It's the inflection where price stops being a signal and becomes a cue. Every 5% spike doesn't just lift the chart. It accelerates physical withdrawal. Bloomberg confirmed it. After silver broke $90 in January, physical premiums didn't just rise, they stayed 220% above spot for 47 days straight. That's not speculation. That's velocity. That's metal vanishing faster than mines can replace it. And that 800 million ounce cumulative shortfall documented by TSCS Substack isn't theoretical. It's the inventory you're drawing from right now. Not surplus. Not buffer. The last layer built over decades now being liquidated, ounce by ounce. So when price jumps, it's not traders reacting. It's refineries throttling output. It's vault clerks updating priority lists. It's loading docks logging serial numbers, not weights. This isn't a bull market. It's a breakdown event. And breakdowns don't reverse. They reset. Silver's next price isn't found on a chart. It's discovered in the vault when the clerk checks your name. At the refinery when the scheduler moves your order to the front. In the solar factory loading dock when the forklift lifts your pallet first. Not because you paid more, but because you showed up with cash, with custody, with a contract that says, deliver metal. Not promises. Not paper. Not arithmetic. Metal. And right now the only thing standing between you and it is the queue.